So now we get into one of the most important elements of trading. This is an area that most traders have the most trouble with. And yet, other than correct position sizing and risk management, it probably has the biggest effect on whether or not you're going to be a profitable trader. And of course, this element that we're talking about is profit exits. So let's kick things off. What's the most often quoted trading rule that you've heard? What's the one thing that you read about in all the trading books and you hear people saying over and over and over? Well, let's take a look at it. The number one most quoted trading rule by far is that you should cut your losses short and let your profits run. Now, the first part of it, the cut your losses short part, we discussed rather extensively in the trading framework section. And that's an extremely important part, and if you can't do that part, then you'll never make it as a trader. But assuming that you've studied that and you're putting those principles into place, let's turn to the second part of this quote, which is to let your profits run. Now we all hear that, but what exactly does it mean to let your profits run? What is considered letting your profits run? How much should you let them run? Do you always let them run? Those are the questions that traders often ask. So let's get into that. What's the first thing you need to let your profits run before you do anything else? Right? Have a think about that. There should be something that it all starts at. And if you've thought about it, it would be clear to you that to let your profits run, you first have to have enough profit potential in the trade to begin with. Right? Letting your profits run starts with having enough profit potential to begin with. Now, this seems pretty obvious, but the problem is that so many traders get into trades where the reward to risk just isn't there. If they're putting a stop at all, the profit that they're trying to shoot for is often less than the size of their stop. And if that's the case, you're going to need some pretty great accuracy to turn out a profit. All right. Now, when we think about letting profits run, we tend to think about, big trending moves and just letting it run and run and run. All right. We'll get into that, how to, take profits on trend days in specific. But for now, we're discussing it in general terms. And while it sounds great to just let profits run and run, you have to realize something. And that's that in day trading, you're highly restricted by time. Okay? And this means that you have to be skillful in gauging how much movement you're likely to get in any given day. Now, if you're a longer term trader, if you swing trade or you position trade for months, then there's nothing forcing you out of a trade at any given time. And if you happen to be in the right conditions, you can really let things run and run. But in day trading, right, you are restricted by the market close. The market open and the close define your trading opportunity. And a lot of times, the bigger picture can be pointing to a very sizable move, but that doesn't mean you're going to get that move that particular day, right? And if you happen to get in at a good setup, the skill that's needed is to be able to determine how much movement you're likely to get in that particular day, and taking it a step down, it's how much movement you're likely to get before things reverse. Because, even within a day, you could eventually reach an extended target that you think could be reached, but not before, you get a tradable move. Then the market comes back, would give you a loss if you had stayed in the trade, and then goes to the eventual move. This happens a lot in day trading, so you gotta be able to gauge the likely extent of any specific move that is happening off of your setup. Okay? Now, to do that, you have to realize two principles in essence. And we've already talked about these quite a bit, so they should come as no surprise to you. But the first principle is that your exits will depend on the character of the day, and the character means the direction and the volatility. So what's the directional bias of the day? How strong is it? How much directional conviction is there? And what kind of volatility are we seeing? Are the bars really narrow? Is there very tight movement? Or are we seeing some big ranges develop, right? And both those things are going to greatly affect your exit on any setup within the day. Like we had already discussed how those things affect the setup itself, which ones you take at which zones and all that. But now they're also going to affect the exit. Okay, for instance, if you're not seeing much directional conviction either way, long or short, but you have a good zone and you take, let's say, a long off that zone, then most likely it's just going to be for a smaller tradable reaction because the market's not just going to take off in one direction to give you an extended target, right? And the volatility is not likely to support a bigger move. So these things will affect your exit. And by the same token, the second principle is that your exits will depend on the character of the bigger picture market environment. All right? So again, just like in setups, we looked not only at the specific day, but at the surrounding bigger picture, the trend and volatility of that environment. Well, this is also going to affect your exits naturally, right? If you are in a bigger picture environment where you had just broken out of some major balance and now you're trending down strongly on the bigger picture, right? You have directional conviction and you've gotten a volatility expansion. Any trade you take on a specific day in this kind of environment, all things being equal, you should go for bigger profit exits in terms of points than you would under slower, less directional conviction environments. And that's because when you have directional conviction and expanded volatility on the bigger picture, you're going to get more directional moves intraday. And some of those extended targets will be reached, and they'll be reached pretty swiftly, right? So you always, all that preparation, all that homework that you do to prepare the strategy and the tactics and the different setups, you have to use all those insights in your exits, okay? It's always going to be this dynamic, fluid reading of the market to determine your exits. Don't think that you're just going to have a one size fits all. I always take, a couple point exits. That's not the right way to trade things. Okay, and yes, this will take skill and experience, but that's what this whole training is about. You're getting all the principles, you got the drills in the beginning section to keep going through them. You got to practice in real life, and you'll keep getting better at it. This is very doable. All right, and this is what separates the pros, again, from all the retail traders that are just trading mindless setups without all this contextual awareness. Now, having said that, you're not left completely in the dark just to decide on the exits purely on context with no sort of structure or organizing thought process. So we've actually put together 5 specific techniques to help you exit effectively at a profit, and 3 different rules that will guide your use of those techniques. So we've tried to structure it as much as possible for you to guide you along this process of choosing the correct exits, all right? Because it's a very important element in trading. So let's get into those techniques and rules, and then in the following section, we'll see how those can all be put into action. All right, technique number 1. Exit at the next support resistance zone. Now, this seems very logical, and it is. If you've just entered at a certain support or resistance zone, one technique of exit is to wait until the price hits the next important support or resistance zone. Because in essence, until price hits the next support resistance zone, it should have less struggle in its movement, right? The opposing side will not be as active in the middle spaces as they are at the support resistance zones. So relatively speaking, all things being equal, it should be smoother sailing towards that next support resistance zone. And then once that hits, you could very likely see a reaction the other way, so often it makes sense to take your profits there. Now, that doesn't mean you always take your profits there. You could see a much bigger extended move based on a bigger setup, bigger picture, everything pointing to the fact that you're going to break through some zones, and that's where the contextual awareness comes in. But the point here is that one of the techniques is that it often makes sense to exit at the next support resistance zone, and if it's not the next immediate one, if you think there could be a bigger picture move in the day and you're seeing confirmation of that, then maybe the support or resistance zone after that, the next important one. Okay? And we'll take a look at examples of these. So, on to technique number 2. Exit when price exhaustion occurs. Now, we took a look at how price exhaustion can be used as a setup, like to enter at a zone where price exhaustion has occurred, right? But if you're already in a trade from a different zone and price is moving and you see a form of price exhaustion like a major volume spike or a tick extreme after price had already moved quite a bit and now it's coming like as a blow off type thing, well, it often makes sense to take your profit right there because, depending on context, that could be the end of the move. So you don't want to lose your profits. Now, you don't want to overdo this and take profits at any time that an exhaustion occurs, especially if you have, a very logical target and conviction that it could reach that. The price exhaustion could be just a temporary stopping point where price retraces a bit and then ends up moving to your eventual extended target. So you got to be careful with this one, and we'll talk about that a bit later with a specific rule. But often it makes sense to exit when you see price exhaustion, especially if it's a strong form of exhaustion. You get the high volume spike, the tick spike, and price itself shows a big volatility expansion after it's already moved quite a bit, right? Like we said, you want to see the big volatility expansion on the breakout usually, not after it's already had a lot of movement. So this is often a good time to exit. Now, technique number 3. Exit when meaningful divergences appear. Again, this was used as an entry setup, but if, for instance, you're going to enter short at a meaningful divergence, well, doesn't it make sense to exit your long if you see that meaningful divergence? If you're already long, well, of course it does, If it's good enough to cause you to enter short, it's good enough to get you out of your long. So these can often prove to be good exit points. And again, you got to be careful here because we still have that adage of letting your profits run, and you can't be looking at the smallest tiny divergences every time and just getting out using that as an excuse to get out. And we'll talk about that specifically. We'll give a couple of rules for how to avoid that. But all things being equal, if you're in a trade and then you start to see some major divergences in the market, then often those prove to be good points to get out of your trade for a profit and not let that profit be lost. Now, technique number 4. Exit at a statistical target. Now, this is something that a lot of traders are not even aware of. But, since we have some reliable stats of market behavior, of how the market moves, what it does, a large percentage of the time, then we can use this knowledge at times to help us pick an exit target that has high odds of being reached based on pure historical stats. And this is something very powerful that can help you get much larger profits than you usually would be able to by making you realize that the stats say that this extended target has a high likelihood of being reached if your read on direction is correct. So often this can be prove powerful to give you large profit exit, and it's a great technique. And we'll discuss the specific stats that we personally use when we show you this in action. And finally, technique number 5 is to exit when a typical market rotation is reached. Now, what does this mean? Well, every market has its own price character. And if you study the market enough, you'll get to know what the typical rotation is. And what we mean by rotation is what are the size of the moves between major swing highs and lows during the day. Now, of course, there's no exact answer about this. This depends on what kind of day it is, right? Is it purely range bound going from the top of the day to the bottom? Is it purely trending and all that? And it also depends on the bigger picture volatility environment. When things are very volatile, a typical move, for instance, in the S&P might be 7 or 8 points, whereas when it's low volatility, might be only 4 points, a typical rotation, for instance. So this one is not like some direct answer, but as an example, if you've been noticing that in the recent market environment and even currently intraday, that when price hits some sort of resistance zone in the correct context, it has at least, a 4 point move before it has any real retracement of that move, then often this can give you a minimum profit target when you're trading off those zones in the absence of other ways to exit. Okay? So this one's more experience based, but it also has to do with the power of observation. And the more you watch the market and you're paying attention intently, the more you get a feel for what's a typical move that you can likely get off of certain levels, right? And it also helps you not shoot for too much profit at times by studying what is the usual rotation of the market off certain levels. And so those are the 5 different techniques that we use, and we'll start putting them into action in the next session. But let me give you 3 rules that will help you put them into action more effectively. All right? Just serve as some sort of guidelines for you. So, rule number 1 is that if you lack conviction on how far the market is likely to move in one direction or the other, and or you don't have a specific logical target nearby that you're shooting for, you can scale out of half of your position at an economically viable level and then exit the rest using one of the techniques that we just discussed. So what does this mean? Well, in any specific trade, based on the context and based on all of your analysis and based on how everything's setting up, right? You're going to have a certain level of conviction. And of course, this comes with experience. The more experience you get, the better you are at gauging the conviction. But, even when you just use the principles you've learned, you should be able to have some certain levels of convictions just based on the odds and everything we've taught you about how markets behave usually, right? So that should help you. But you'll basically have a certain level of conviction of how far the market is likely to move, and there will often be some logical target nearby to shoot for. Now, if you don't have much conviction, let's say you get a setup, okay, and you feel like based on everything that you've seen, the odds of getting a reaction off that zone are quite high, but you really don't know how much the market could move after that. The context is not giving you a clear idea, so you don't have much conviction in how much it could go. You just know that it's very likely going to react off this level, and that it'll be good enough in terms of a reward to risk ratio in general based on where you put your stop. And there's no specific target nearby, or you're not sure if it could even reach an extended target that's many more points out. So one way to go about things in this instance is you get out of your position, okay, at an economically viable level. Now, what is an economically viable level? Well, we discussed this extensively in this session when we talked about the requirements of a money-making strategy, right? And basically we said that it really should be at least 1-to-1, and even there, the stop has to be large enough to give you a large enough profit exit when you go 1-to-1, so that the commission and slippage don't erode too much of your edge, don't become too big of a percent of your stop size and of your profit exit. Okay, and so for the S&P we said should be at least a couple points wide, and you should really not be scaling out of your position before a 1-to-1 ratio. So if you have a 2 point stop, you shouldn't be scaling out for less than 2 point winners. All right, I know a lot of trading teachers out there teach, you scale out for this very quick initial profit that would maybe is half the size of your stop just so you reduce your risk. Well, let me tell you from now, that's not the right way to trade. You are reducing your edge. It's trading based on fear. And overall, while it might feel comfortable, it's gonna be bad for your bottom line. Anything that you do just for pure comfort's sake is not going to be good for your bottom line, because that's what most traders want to do. They want to feel comfortable, right? And you got to condition your mind, like we said before, to sit with the discomfort. And so, the thing here is you can get out of half of your position, but make it at least 1-to-1 reward to risk. Because what that'll allow you to do, since you didn't really have the conviction, now since you've gotten out of half, even if the rest of the position will go all the way to your stop, you're still at a break-even trade. So you can be a little more relaxed and just letting it play out and seeing where the market could go. But you don't just do it blindly. Then you look at the other techniques. If you see a major exhaustion, you get out of the other half of your position. If you see some meaningful divergence, or if you end up hitting a zone, that kind of thing, then you get out of the rest of your position. And one note here about moving your stops to break even, don't be too quick to do that. If you get out of your half of your position at 2 points, for instance, like at 1-to-1, don't be quick to move your stop to break even. A lot of the time you're just going to get taken out by noise. The whole point of taking out your half your position is to be relaxed enough to let the other positions play out, and a lot of times that'll mean the position coming back to your entry level, maybe even going through a little beyond it towards a loss, but then going to the eventual target. That's the point of taking that, sure exit at 1-to-1, for instance, right? And we'll get into that again later. So this is what you do when you lack conviction, or there's no specific logical target nearby that makes sense in context. But rule number 2 is that if you do have conviction on how far the market could move, and you do have a logical attainable target, then let the position ride, i.e. don't exit half your position. Now, traders, and again, a lot of educators support this just because they know what sells. They want traders to feel good, and they know traders will, buy into their system if it makes them feel good to ring their cash register. So they tell them always scale out. Well, yes, that feels good, but you got to do what's logical, right? Let's assume you have a very strong zone, and the market is coming into that zone, and it's almost like an automatic buy because everything is looking good. The sellers don't really have conviction, and they're hitting a very strong zone, and this zone is aligned with the bigger picture, which is also up. So realistically speaking, the odds of a big bounce off this zone during this day are very high. Well, why on earth would you take half your position off, for instance, at 2 points or whatever it may be in your market, while the very likely move could be 8 or 10 points? Now you could say, well, that allows me to, ride the full move to the 8 or 10 points if I don't have risk. Yeah, but again, the better thing to do would be to train your mind psychologically, and we're going to get into that in the whole psychology section in very much detail. But wouldn't it make more sense, instead of just blindly exiting always to just feel good and comfortable, wouldn't it make more sense to train your mind in the correct situations to be able to ride that discomfort? And so what if it goes to a loss on that specific time? Right? That's what you might be thinking. Well, if I don't take the half scale, it could turn into a loss. Yes, but again, how many times have we said, look at the bigger picture, think in probabilities, think long term. Once in a while it'll be a loss, right? And you might get upset that you didn't scale out for half your position, but all those other times that it does go, 8 points, well, on a 2 point stop, you're going to have 4-to-1 reward to risk. Whereas if you had scaled out of half your position at 1-to-1, you're going to end up with a 2.5-to-1 reward to risk. All right, you've just lost 1.5 R, which is a bigger loss in terms of opportunity than a -1 hour loss, right? So you'll be hurting yourself, trust me. So in these instances, when you have the conviction and there is some logical target that is likely attainable, put the position on and let it ride. Let it get there, okay? And again, to follow that adage of letting your profits run, you're going to have to be able to sit through retracements against your profits. You're going to have to, be able to see a 4 point winner come back to break even if, the potential's for 12 points. All right? In the right situation. You don't do that if you don't have overall conviction, right? Then you just take the exit at half the position. But if you do, you gotta let this thing, you gotta see yourself being up profit, then it comes back, and then it goes in your direction. You gotta let it play out. And the key to doing that brings us to rule number 3. And that's that you do not micromanage the exit on a smaller time frame than you used to enter. Now, what does this mean? When I'm talking about time frame here, I'm not specifically per se talking about, what type of chart you use, like if you're using 1 minute chart. For instance, let me give you a quick example and we'll get into that later too. But if you had the scenario I just talked about of some major support zone and the sellers are moving into it with not a lot of conviction, and the bigger picture trend is up, and so you're seeing, makes a lot of sense that we're going to get a big bounce, all right, and you enter at that zone in anticipation of the big bounce. You don't then go into the chart and you're looking at a 1 minute chart, even if that's what you were using to enter based on all that bigger context. You don't go now and exit when you see a small divergence on a 1 minute chart, from one candle to the next candle that happened 5 minutes later. That's just something tiny. That would be micromanaging the exit. That would be like zooming in, right? And getting out of a bigger picture move based on a little thing that's likely to make the market move down, let's say 2 points, and then resume the bigger move. So this is what micromanaging is. And trust me, early on in my career as a trader, I experienced this the hard way. I'd always be, trying to overread things, overanalyze, and getting deep in, where a lot of the time, if you get in like that, sometimes it just makes sense to just slap on a 5 minute chart, right? Even if you normally use 1 minute charts, so you don't even see those little patterns that are just going to fake you out, because they're going to cause, a couple point retracements or whatever it may be, and then they keep going, and you're sitting there exiting a bigger picture move that would get there anyway, right? And we'll look at some examples of this, but this overreading will really hurt you. So that's why this rule is here. It's to keep you out of trouble. All right, and those are basically your 3 rules that you use to then apply the different exit techniques. Okay, and in the next session, we're going to start getting into some examples of these in action, right? So now you have all these high-level principles to guide you. Go through the key takeaways PDF, reread these, make your own personal notes about them if you want, list things that'll help you keep them in mind. And then once you understand them at a deeper level, after you see them in action, you can start using these things to greatly improve your own profit exits.